Yeah, good afternoon. In today's class, we are going to discuss about the method of computation of income from house property. So yesterday we have seen the meaning of income from house property. When we say the income from house property, any income which has been received either in the form of let out, in the form of rent, or with the profit what we received by selling of the house, those two things are being considered as income from house property. Okay, so here we are going to discuss now the how to compute the income from house property. A very important thing what you have to note, while calculating the income from house property is, while determining it, so you should know that according to the income earning capacity of the property, but not on the basis of actual rent received. Say, for example, if I have a house and if I've let out uh, for 6,000, but whereas actual rental value, according to that municipal value, it is for 8,000, then I cannot show to the income tax authority that I only received 6,000 per month into 12 months, 12 6 is 72,000. That is wrong. But here, actually, you have the municipal rental value fixed as 8,000 and its a market value is that, but you have given it less value. Then here, what they are going to consider is the income from house property is considered not on the basis of what actually rent received, but what is determined as an income by the municipal authorities or by the or the earning capacity of that property. So this is one important thing that you have to note down when you are calculating the income from house property. Now, here one important term that we are going to use while calculating the income from house property is the annual value. Annual, you know it, that yearly value. According to section 23 and subsection 1, the annual value of any property shall be the total for which the property might reasonably expected to be let out from year to year. That means by letting out the property, what annually we can fetch is considered as a annual value. Now, how to calculate that annual value and what factors are to be considered? So the following, well, when you're determining the annual value, the four following factors are to be considered. That is municipal rental value, actual rental value, fair rental value, and standard rental value. Now, coming to the municipal rental value. Now, what is this municipal rental value? So actually, it is a rental value fixed by the municipal authorities. In cases of municipalities, if your house or property is situated, in case if your property is situated in Gram Panchayat level or the local authorities, they are going to fix certain value as a rental value for the purpose of levying the tax on that house property under their jurisdiction. So that value is called as municipal rental value. Yesterday we were discussing that, sir, income, if we don't pay the income on the value of that, if you are not paying the tax, then you are trying to evade the tax. No, your municipal rental value, as you know that either local GHMC authorities or the municipal authorities or municipal the panchayat authorities, they are going to collect the property tax. So for the purpose of collecting the property tax, first they have to identify what is the municipal rental value of that of a house in that particular locality. Based on that, they are going to levy the tax. So every house situated either in the municipal authority or at local Gram Panchayat level authorities is going to be determined by the concerned local authorities. So when they are determining, they determine at the two stages the value of the municipal rental value. One we call as gross municipal value and the net municipal value. Now, what is the gross municipal value? Gross municipal value is, it is estimated rental value of the property according to the municipal laws or according to the local authorities. Now, what is net municipal value? Net municipal value is from the actual value what has been fixed by the municipal authorities or local authorities, from that some deductions will be allowed, like sewerage tax, water tax. These two are allowed by the municipal laws because they are going to collect these. So that after deducting these two, what you get is called as net municipal value. So municipal rental value is being fixed by the either local municipal or gram panchayat level for the purpose of levying the tax is called as municipal rental value. So this thing has to be considered while calculating the income from house property. Then we have after municipal rental value, we have the actual rental value. What is actual rental value? It is the rent received or receivable from the tenant in a particular period, financial year, is called as actual rental value. As we have taken just now example, actually the municipal rental value is fixed as 8,000 rupees, but I gave it to my friend or to my relative or to my brother or sister at 6,000 rupees only. So here the 6,000 rupees is the actual rental value, what I am receiving it. But as per the municipal rental value, it is 8,000 rupees per month. Okay. Now we have fair rental value. When we say the fair rental value, it's also called as notional rental value. It means the rent of similar accommodation in the similar street or in the similar locality is called as notional rental value. Now, suppose you are showing it, you are showing, or I'm telling that no, I have I gave it this house for 6,000 rupees only. But whereas in the next lane or in the same street, the other person gave it for 8,000 rupees. Then definitely it is going to be differ. So that they are going to check it in the same street, what is the renter value with the same accommodation provided, is considered as a fair rental value. Then we have standard rental value. Generally, this is certain areas comes under the Rent Control Act. According to the Rent Control Act, the rent is going to fixed by the government agencies or by the rent controller. So the owner cannot fix the rent and he cannot ask the tenant to vacate as per his wish or will unless he take permission from the rent controller. So the standard rental value is the rent which is fixed by the rent controller under the Rent Control Act. So these are the four important things that we have to know it when you are calculating the and when you are determining the annual value. So generally there are types of house properties which has been let out are of four types. One is let out property for residence or commercial. Generally, as we know that when you have a house, you might let it out for residence or you might let out for commercial purpose. Sometimes the same house might be occupied by yourself for your own residence. And third one, deemed to be let out property. You might have been let out to someone else or like to a spouse, to a brother or someone else. Then another residents might be there partly let out and partly self-occupied. So total building has two floors. One has one you are self-occupied, another one you have been let out. So that is called as partly let out and partly self-occupied. So these are the four types of house properties are there on the nature of occupation, on which you have to calculate the value of income from house property. Now, first one, let out house property. You have let out either for residential or commercial purpose, let us assume. Now, how to calculate the income from house property? So this is a format that you have to put heading computation of, say for example, Karan Dutt's income from house property for the assessment year 2021. Okay, this is what. After that, again, you have to draw the two columns, one for particulars, the big column, and other one amount column as a small amount. the small column. So now in the first column, we are going to take is the gross annual value. Now, what annual value we have discussed just now, as you have seen that the annual value is the value which your building or property can earn income in a particular year is called as an annual value. So based on that, when as you know, when you are calculating this GAV, you have to consider four things. One is municipal rental value, fair rental value, actual rental value, and standard rental value. So how these four things, when you consider, you'll get. Now how to calculate the GAV, we'll discuss in the next step. But first, what you're going to take is GAV. The GAV, that is nothing but gross annual value. Suppose if he says gross annual value is 1,20,000 per month, 10,000 on the basis, 1,20,000. Less municipal taxes paid by the assessee during the previous year. How much municipal taxes he paid, that you have to write. Then from 1,20,000, 10,000 rupees you paid municipal taxes as sewerage tax and property tax. So 1,10,000 here you will get it. That we call it as the net annual value. Okay, and from this net annual value, there are certain deductions are allowed under section 24 of income from house property. That is under section 24A, standard deduction 30% of NAV. For example, here 1,20,000 is the GAV, and from that, let us assume you paid property tax or sewerage tax 20,000. You got 1 lakh here. From 1 lakh, 30% is deductions allowed. So on 1 lakh 30%, 30,000 here you are going to write. And suppose in order to construct that house, you borrowed interest from any banks. On that, interest on borrowed capital for previous year interest is allowed as a deduction. And before constructing, if you have taken any loan, and that loan will be allowed for 5 years, that interest also will be allowed. Both you can be deducted, then you get this income. To that, if suppose in the last month, last year, you have not received rent from a particular tenant, then that if you have received in this current year, you have to add this, or any arrears of rent received, then you get taxable income from house property. So this is how you have to solve the problem by writing this standard format. When you have to calculate income from house property, this is a standard format you have to write down immediately when he is asking to calculate income from house property. After that, now the question arises, as I was telling, GAV. How we will get the GAV, sir? When you want to know that how to calculate the GAV, here, as we have discussed in the previous class also, that as not in the previous class, just in a few minutes back, we have discussed there are 4 types of rental values are there. Municipal rental value, fair rental value, standard rental value, actual rental value. So these 4 things you have to take. So step 1, when you are calculating the GAV, first you should take municipal rental value, fair rental value. Suppose if the municipal people said just now in the example, 8,000 rupees, but the fair rental value, what is the fair rental value? Fair rental value in the similar locality, what is the rent you is going to get? That is called as a fair rental value. So you have to compare both. Suppose fair rental value is 9,000 and the municipal rental value is 8,000. From these two, whichever is higher, that you should take here. Okay, you should compare both, and you have to take here. That we call as a notional rent. And second one, what you received this notional rent from here, what you got, say 8,000, 9,000. When you compare both, 9,000 you got. Yes, sir. So 9,000. From that 9,000, from the 9,000, what we call as the notional rental value. Notional rent. So from that notional rent, yeah. So sorry for disturbance. Again, once again, I'm explaining the determination of gross annual value. When you're calculating the gross annual value, these three steps you have to follow. Whatever the information he has given, MRV, municipal rental value 8,000, let us assume he gave fair rental value 9,000. You should compare, take these two, whichever is higher, you have to put here. So that will become notional rental. That take that notional rental here 9,000 and standard rental say suppose 6,000. So 9,000, 6,000, compare both and whichever is less. So standard rental rent is 6,000 compare with notional rent. So only you have to take 6,000. That we call as expected rent. That we call as expected rent. So you will take that 6,000 here, 6,000 here, and you what is the actual rent you are receiving? Suppose 8,000. So 8,000. So compare 6,000 and 8,000, whichever is higher, then that is going to become your gross annual value when you are calculating. Okay, suppose if actual rent is having any unrealized rent, any common facilities is there, that you have to deduct it. And if any vacancy is there for long period, that you have to regard. Otherwise, these three steps, if you follow it, you are going to get the gross annual value. So by you taking that gross annual value here, then you will deduct municipal tax, then what you get you call as NAV, net annual value. From that you are going to deduct under section 24A as 30%, 24B on interest on capital. So this is how you have to calculate the income from house property. No, we are looking at, we are seeing, or you might have seen under the format, standard deductions are allowed under section 24. What is these deductions? Under section 24, it is compulsory deduction which will be given to every assessee who is having income from let out house. Suppose when you let the house, and say during the month you have incurred repairing expenditure, say by letting the house you got 1,20,000, but you have incurred the various repairings and you painted or you did lot of things, for that you incurred 2 lakhs. Now are you going to show that as a 2 lakhs, but actual expenditure is 2 lakhs? But the government is not going to allow as 2 lakhs as your expenditure or your maintenance expenditure. So the government is going to give only 30% of your net annual value. That means 1,20,000 you received as a rent. From that to 20,000 you paid municipal tax. So you got 1 lakh. On 1 lakh, 30% only will be allowed as a deductions for maintenance. That is called as standard deduction under section 24A. Then we have under section 24B, interest on home loan. Suppose if you have taken any loan to purchase or construct or to repair the house, this 24B is allowed. And suppose if you are paying that interest, you are paying only in India is allowed. Suppose you have taken interest from foreign person, and on to whom if you are paying interest for constructing the house, for renovating the house, it will not be considered as a deduction. And interest on loan will be allowed even on due basis. Suppose you paid for 10 months, you didn't pay for 2 months interest, then also you can show 12 months interest even if you have not paid. Okay, but suppose in the last year you haven't showed for 12 months, you showed only for 10 months, and in the next year you want to show for this 12 months plus last 12 months, that will be not allowed. And any brokerage you paid, any commission you paid in order to let out the house, or in order to raise the loan, that it will be not allowed as deduction. Okay, and interest on loan taken to purchase or to acquire or to construct the house prior to purchase or complete the construction will be allowed as deduction under 5 equal installments. Suppose before constructing the house, you have taken a loan, let us assume, and that will be allowed only for 5 years from the period of construction house is completed. Okay, so this is the rule what is there. Coming to the composite rent. When we say the composite rent, generally we know that the owner of the building in certain cases may provide some additional facilities to the tenant. So those additional facilities like gas, security, water, electricity charges, if those are included into the rent, then that rent is called composite rent. Some of them they don't include in and they exclude it, they call it as separate. Those are separate. If suppose someone is saying, I collect, give me 10,000, including of for all the facilities apart from the letting out of house, then it is called as a composite rent. So here, when there is a composite of rent, there are three situations are there. Composite rent on account of service provided. For example, if you are providing rent is what you are attributing by letting out the house is called income from house property. Suppose by providing certain facilities, by providing some services, if you are charging any extra, that what are the services you are providing for that, that can be shown as income from other sources, but not under income from house property. Service charge received or recovered from tenant should be deducted to call as income from house property, and the remaining one will be shown as income from other sources. Okay, then we have second situation where the composite rent includes rent for using the building and for using other assets, and the letting of these assets is easily separable. Suppose when we can separate the certain furniture rent of the building, how much you are charging for rent of the building, how much you are charging for the rent of furniture, when you can separate it, then you can use it. Under such case, whatever the rent you are collecting for letting out of the house will be charged as tax and under income from house property. Whatever the assets you have been given as a facilities for apart from the house, that comes under income from other sources. Okay, and then the last situation is where the composite rent includes rent for using the building and using for other assets, and letting of these assets is not separable. You cannot separate it. For example, letting of auditorium or cinema hall. Now, can we make separate of auditorium separate and the seats, whatever the facilities, AC and the screen, whatever we have been provided, that you cannot separate it. Under that, the entire amount received can be shown under the income from other sources. Okay, that but one other simple way is in all these above situations, assessee can show under income from business instead of income from other sources. So in today's session, we have discussed how to determine the annual value, how to and what are the factors to be considered while determining the annual value, what are the various types of house properties are there, and how to compute the income from house property, the various deductions available under section 24 and composite rent. So these are the things what we have discussed in today's session. If you have any doubts, you can